Okay. Hi, everyone. So welcome back to the weekly stock talk. I'm taking over for Scott today. So Ben, how's it going?
Going well, but I think you should tell everyone that had a big announcement this week and something big happened. Tell them.
Yeah, I walked the stage at my commencement. I graduated from university. It was very exciting. Very, it was. I was very nervous, to be honest. It was a very weird walk for me, but it was really nice and really cool to have so much support and family and friends and stuff. And the team is very proud of me, I'm assuming. So it was a
Absolutely, we
good
are
week.
very proud. Maybe tell everybody what you graduated in. I don't know if we mentioned it or not before.
Yeah, so I studied financial economics. I graduated in honors and I did co-op, and I also have a minor in business. So I have previous experience and I'm very familiar with the field, specifically in banking. So I'm excited. Now I'm officially a grown up and I'm officially a full-time employee.
There
So
you go. There you go. It's a big week.
yeah, it's a very big week. So it was really good.
Awesome.
Whew. Okay, but how are you?
I'm
How
good.
was
I'm
your week?
good. My week was good as well. The big news of this week in the markets, I guess, was the U.S. central bank. There was the big question what they're going to do with rates, and as we all know now, they paused on raising rates in the U.S. And so the market was pretty choppy on Wednesday after a rate announcement. In the last couple of days, been kind of sideways to ho hum. Had a bit of a correction in commodities the last 48 hours as well. So, I think it probably has a lot to do with where the economy is. So, I think that was probably the biggest economic news this week. And now the question is, what do they do from here? And when we go through the slides, I'll talk a bit more details of what the data said. But yeah, that was the biggest news of the week.
And was it a surprise for you that the rates didn't go up or?
Yeah, so I think it was about a coin toss coming into it. And then as we got kind of close to the final hours, it looked like the market had fully priced in that they weren't going to do anything. If we look at still a year out, those rates hardly changed at all, which is overnight rates probably 1 to 1.5% lower than where we are today. So that's kind of 3.5% or something like that on the overnight rate in the US. So, I think consensus is really that it doesn't matter what they do at this point. They've tightened as much as they probably can, and we're kind of at the top of that cycle. If they go another 25 basis points or not, I don't think it matters too much. But not overly surprised. A little bit that because the Bank of Canada raised last week and they didn't this week. So, but the Bank of Canada raised rates first, and so I think it's kind of neutral because U.S. is still above the Bank of Canada right now. So I'd
Was there
say
any,
not a
was there
big
anything
surprise.
else?
Anything
Sorry.
else? I
Okay.
no. Yeah, I think that wasn't really anything else material that happened from an economic perspective. A week ago today, we saw the jobs numbers in Canada, the unemployment rate start to tick up a bit. Similar in the US, we're seeing unemployment tick up a bit as well. So, these are kind of the last pieces of the recession signal that we're waiting to see, and that continues to come through. And I think
Was
from a
there
portfolio
anything you
perspective,
did in regards? Yeah.
yeah, I think
I
I
was about
cut
to
out for a
ask, did you
sec.
change anything from a portfolio perspective? That's okay.
Yes,
Go for it.
so
So
not
did you change
yeah,
anything?
not really. I still looking at where we are. I think as I've talked a long time over the years that the economy and the markets are different, and so I think we saw a lot of stocks and maybe some markets bottom October, November last year. And if we look at the financials, at least in Canada and the US, Canada and the US obviously quite different because of the risks, but you know, most of the Canadian banks are still down 20-25% off their highs, which should signal that that's recessionary. And in the US, again, like the US banks are still down. I mean, the big cap banks are probably down 20%, but the regional banks are probably down 35-40%. And so these typically are signals that we're in a recession. So, you know, I didn't make a lot of changes. I'm still positioned for that. We own bonds and have cash, and really, I think there's going to be some opportunities in the next 2-3 months that some of these stocks will bottom. So maybe start to look at chipping away, but pretty quiet week from anything new into the portfolios.
Okay. Do you want to move on to the charts?
Yeah, sounds good. All right. So I haven't put this one up probably in a couple of weeks at least, but I think this is the US data. Canadian data looks pretty similar, but since I talk mostly about GDP and inflation, these are probably the two most important things to look at. Obviously, there's a lot going on these charts here. So this is, if we look over on the left-hand side, which I'm highlighting, real GDP quarter over quarter. So this is that top line. So if we look at that going across, everyone remembers, you know, second quarter of 20, you know, GDP was down 29% and then bounced back 35%. So if we look at that line all the way across, most of this data isn't anything too much to worry about. But if we look over on the right-hand side of this, we'd look at second quarter of this year, which is GDP contracted. So minus 1.5%, that's the estimate. Then we look at the third quarter, looks like we might get a bit of a bounce back, and then, you know, Q4 and Q1 of next year, you know, those get into that kind of plus or minus. As I've had conversations with clients this week, the question is, are we expanding? Are we contracting? You know, I think if we look at the trajectory here, it looks like we're going to be plus or minus 1% in GDP in the US. Canadian data actually looks a little bit worse than that. So that's the top line. And the second line would be inflation. So if we look along the bottom, headline CPI year over year. So we went through this deflation phase. Then the central banks pumped a lot of money into the economy, which obviously caused this inflationary pressure that we're seeing. Now it's starting to wane a little bit. So, you know, we head towards that kind of 3% number, which I think is a pretty psychological one. So it continued to look at that. But if we're to interpret this is GDP slowing, inflation's kind of sideways. That puts you into kind of a stagflationary environment, which is you want to have some gold in US dollars. That's what you want to own in that particular backdrop. So it's interesting as we listen to the central bank this week, and we look at this effectively. You know, I think yesterday I put out the chart which said 0% of the Fed members think that we're going to have a recession in the next 12 months. But then, interestingly enough, if you look at what the Federal Reserve Bank of New York says, the U.S. recession indicator has a 71% probability modeled right now. And if you look at the conference board's data, that's sitting at effectively, you know, 100%. So 99% likely that we're going to have recession in the next 12 months. So, you know, they say one thing, but the data is telling us something else. So I think it's important to look at the data because I think that's what the market's going to price in, and effectively that's what they're going to do at some point when they come to terms with where we are in the cycle. So this is just kind of a snapshot to look at when we had the first hike to where rates are today. We look back through all previous cycles just to show you the severity of which rates have tightened right now. And so I think it's important to think about all of these impacts are playing out into the economy, albeit pretty slowly, but rates have skyrocketed compared to any of the other past cycles that we've been through. Just a couple more slides. You know, I like to look at multiple data sets together to try to understand what's happening. And so this is Canada cycle lows, and obviously we're at the lowest level since 1990. And what are the major inputs here? So the blue line, we look here, the blue line, this is the EWC, which is effectively the TSX. excuse me, listed on the US. So this is Canadian stocks listed on the US versus the 2s, 10s. So this is the 2-year bond rate versus the 10-year. So if we look at these previous periods where we get these big depressed levels, what tends to happen in this backdrop is, if you get stocks correcting, this is the 2s, 10s going in the other direction. That means yields are coming down collectively in that backdrop. And now we see the widest margin that we've seen since 1990. So I think it's relevant just to understand that in this backdrop, you have bonds going up in value and yields going down, and likely stocks going down as well. So continue to watch how and what this impact's going to have. Two more quick ones. I put this up multiple times, but this is just positioning. And so when I think about the economic backdrop, I think what's happening, what are we doing, and then how's the market positioned for that setup? And so as we come into, I'd like to just draw reference to the 5-year right now. So this is the 5-year bond rate in the US. And so right now you have the market kind of seeing, well, they're not going to raise rates right now. And so they've been pushing the 5-year bond very short. So this is kind of max short position, over 1 million short contracts on the 5-year bond. So as I've said in the past, when that starts to move in the other direction, the market starts to see that we're in this period where rates go the other way. When this starts to reverse, you get a massive flow of money in the other direction, and that's how the yields fall and prices go up. Other ones here to look at, but I think the 5-year is most relevant right now. So the last one before I'll see if there's any questions, then we'll wrap up is, as we think about what has been happening in China, and we think about there's this kind of been this ongoing talk that Chinese companies are banned from doing certain types of things. And, if you follow the news, you think probably the opposite of what this chart is showing you is that the number, if we look at the headline, number of Chinese sectors barred from foreign investment. And so that number was quite high, and it's actually shrinking right now. And so it's interesting to see where kind of behind the scenes, the economic market of China and a lot of countries are starting to work together better. Their country's starting to, obviously, there's some slowdown there, but they've started to ease financial conditions, as I've mentioned in the past couple of months. So I think it's relevant just when you think about what do we want to own and where do we want to be positioned. China, I still think, has a good risk reward, obviously significantly higher risk than certain areas, but I think still worth paying attention to at this point.
Oh, okay. Well, that's good.
Did
That's
you
a
learn
lot.
anything?
So much. I have a degree now. I don't need to learn anymore.
Never stop.
Was there anything that clients were asking about specifically this week?
Yeah, so I continue to have questions about what happens now and where do rates go from here. And so I've had lots of questions about that. We've had some questions around, should I buy GICs or should I buy bonds? And the GIC rates on 1-year GIC is around kind of 5.25 right now. The kind of thinking is, do I want to lock into that, or do I want to buy a bond a little bit further out? I think the answer is you probably want to do both because that GIC gives you some stability, but those bonds, if you buy a 3 or 5-year bond, if rates play out like I expect them to, when yields start to come down, that means your bond component is going up. And so you're going to have a benefit from that bond going up in that backdrop. And when you have to roll over that GIC, it's probably going to be rolled over at a lower yield. So I'd say kind of hedging your bet right now. I've been thinking about it both ways right now. So that I've had the question about quite a bit. The other one is about, what to do with short-term savings. What should I do? And so the answer to that is similar, where yes, you can buy a GIC, which gives you some stability there. But if it's in a taxable account, you probably want to buy a bond. So you can buy a 1-year bond that's going to pay you the same. but you're going to make capital gains. And if you're in the top tax bracket, effectively, you're only going to pay half of that in tax versus the GIC. So depends where the money's invested.
And are you looking at anything specific for next week?
Well, I think this was a big week with the central bank meeting, and so there's a lot of strange positioning coming into it. We had massive call buying in the S&P 500 in the last 2 days, so kind of record high call volume. So that's probably going to unwind. And so I'd expect a little bit of the downside in broad markets. And so if something different than that happens, then maybe it makes some changes. But I'd be watching to see how that plays out and what's going to be the impact.
Okay. Are there any questions, comments, feedback, all that good stuff? I think we're good.
We're good. Okay.
I think
So,
Final thoughts.
Final thoughts is, well, I guess the last couple of weeks, well, at least since you've joined, I've been mentioning that you're reaching out to clients to book meetings, update account documents. So
Mhm.
certainly, if you see Renad's email, please have a look at it. And if you do want to book a meeting, reach out to us and we can schedule that in. Most of the meetings now we've been doing over Teams or Zoom. So I think continues to be a good way to go about it. And so if you do have a preference when booking, certainly let us know. I think that's it for me.
Well, thank you everyone for joining. Thank you for watching. But that's it for me too. I think we're good.
Perfect. Thanks, everybody. Thanks, Renad. Take care.
You too. Bye.
Bye.